Good morning. My name is Aditya Patnaik. I am an investment advisor at Sprott. The following excerpts are from a discussion I recorded with Rick Rule on the 17th of April, 2024. The focus of our discussion is primarily on opportunities in the silver market today. Please email me if you would like more information on specific investment opportunities within the different segments that are underscored by Rick during this discussion. I wanted to talk to you primarily about silver today. This was on the back of the email that we'd exchanged a few days back, where you used the phrase coiled spring to describe silver stocks. And I haven't heard you use that phrase very often, so I thought it would be very timely to capture some of your thoughts on the opportunity that you see in the silver space today. And to add some specificity to it, I thought it would be quite interesting to look back at the price chart of Pan American Silver from 1995 to 2015, when they went through one full cycle in terms of what the share price has done. I think there are some important observations, and as you were an early shareholder, I'd be very interested to get your thoughts on why you held and when you sold that share over that cycle, if you did at all.
Great. I need to start by saying that when I talk about the silver spring, if you will, being coiled now, I'm probably referring more to the disappointment surrounding the sector rather than necessarily the opportunity which was available back in the days of the formation of Pan American Silver. So in order to understand, if you will, the differentiation, if my memory serves me correctly, I got involved in Pan American Silver sometime around 1989 or 1990, just as Ross Beatty was putting it together. His concept then was that we had been 10 or 12 years since silver had been in favor, that there were a lot of silver deposits that had been discovered in the decade of the 70s when the public perception around precious metals were a lot higher, and that those silver properties had no net present value at $3.50 or $4 silver, but could have a substantial net present value at some number like $10 or $15 silver. Yet the deposits that were available for $2 million and $3 million had perhaps $100 million spent on discovering them. So Pan American Silver had a unique vision at a unique time. And they also were unique in the sense that when the company started, the share register was controlled very tightly by a group of people who had come to know Ross Beatty very, very well and shared his vision. What attracts me to the silver equities market now, and in the last 10 days, we've begun to see evidence of it, is that you get the most dramatic moves often in a bull market when the commodity itself, in the eyes of the investing public, moves from being hated to being tolerated to being loved. And the silver market, since the failure of the sort of Reddit silver squeeze in 2020 and 2021, has been really hated. That's turned around. I think a couple things have happened. I think part of the coiled spring has to do with seller exhaustion, which is to say anybody who wanted to sell silver stocks in the period 2022 to 2024, particularly speculative silver stocks, had ample time and ample excuse, in addition to the fact that the silver price declined. There have also been real political challenges in various jurisdictions that are important to silver, but particularly in Mexico. So, in addition to the fact that there have been market related forces that cause the silver business to be hated, there have also been political and social events which have piled on the hate. I'm not suggesting that the political and social events are gone. I'm suggesting that the hatred in the sector with regards to those events was given extra fuel by the metal itself, and that the reaction to it was extraordinary. And the reaction, I think, is over sooner rather than later. Uh, and you will see from the charts what happens if you happen to be right.
One of the things I was trying to highlight by looking back at history here is that in the mid 90s, there were a bunch of folks who clearly saw an opportunity in silver, including Buffett. But it wasn't until 2002 or 2003 that the market did finally take off. And a lot of folks who have been in the market over the last few years and that have been watching the silver market have experienced the same trauma of dealing with a question, which is the when question rather than an if question. I've asked you this question in the context of gold in one of our previous calls. When we're looking at a commodity which is above its incentive price, as silver is, whether it's at $23 or $28, most of the sector is producing silver below that number. Similarly, for gold below 2000, most companies are producing gold below 2000. As an investor, how do you think about the price of silver from here on, particularly given the experience that you had in the 90s where silver went from 5 to 50?
Remember that analyzing precious metal stocks the same way that you would analyze oil and gas or copper is problematic. With regards to gold, most of the gold that's ever been mined is still supply. So, new mine supply relative to current demand becomes a laughable statistic. Similarly, silver is a little different in the sense that about a billion ounces of silver a year, pardon me, go to silver heaven, which is to say they're consumed. Some amount of that is recycled. But when you talk about the incentive price in silver, most silver that's produced on a global basis is produced from recycling or is produced as a co-product or byproduct around copper, lead, zinc, and gold production. So establishing an incentive price for silver is a difficult thing to do. You can establish an incentive price for silver miners. And if you look at the free cash generation of the community, including the very efficient ones like Fresnillo, what you will see is that the incentive price for putting new silver mines in production is much higher than the current silver price. That won't impact supply all that much because silver produced from primary silver mines accounts for less than 20% of new silver supply. So with regards to both silver and gold, the equation has more to do with demand, and in particular, the intensity of the demand. You've seen gold move very recently, despite retail selling. You've seen it occur because there is a class of investor, primarily foreign central banks, that have an absolute need for a medium of exchange that's simultaneously a store of value that is not U.S. Treasuries. So, despite retail, at least Western world retail selling of gold as expressed by the ETFs, you're seeing the gold price move up. Historically, what has happened when the gold price moves is that silver moves later, but it moves further. In the middle part of the decade of the 90s, so really in the early part of the decade of the 90s, I saw, I guess, the same thing that Buffett saw. I saw an asset class that was just so thoroughly out of favor that likely the sellers had been exhausted, where I could buy meaningful amounts of silver equities for fairly small amounts of money, where if the sector returned to favor, almost irrespective of fundamentals over some period of time, that the return on capital employed would be extremely high. It was what was true then is true now in the sense that the combined market cap of every legitimate silver miner on the planet was so small that to the extent that the narrative for silver changed at all, uh, that there was coiled spring type upside in the market, which is precisely what I see today. I see that changing just as we speak, which is why I sent you that email.
One of the things that I find very difficult with precious metals is quantifying the magnitude of the move. In early 2000, Pan American Silver was writing down its assets that required some of its assets, in addition to Ducat, which was a different issue, but some of the other assets had a higher cost requirement between $7 and $9 silver, and silver had fallen to $5 at the time. So it seems like the magnitude of the move is also very difficult to predict in addition to the when question. So given that we have all of the upside ahead of us for this cycle, how do you think about that as an investor in silver stocks?
I don't. Uh, I realize that it's impossible for me to quantify the magnitude of the upside. So I don't try. With regards to timing, while I would prefer to know the timing, I don't. And so I don't have much concern over things I can't control. Uh, I have used the phrase often in our interviews that I like circumstances where the outcome is inevitable. It may or may not be imminent. What I have found is that the best gauge of imminent to me is extended periods of hatred with regards to an asset class. So I have no concept as to how high the silver share prices can go. I have no concept as to how high the silver price can go. Understanding that I have no concept of it, I don't have very much care about it. Can I talk around it? Sure. If we assume the precious metals bear market is driven by gold, which I believe it is, we can talk about, in an Eric Sprott sense, how high could it go? A lot of people right now in the gold market are uh, pathologically excited about a move in the gold price above 2,000 and now to 2,400, which is to say a 20% move in gold. In the historical context, that's an irrelevancy. If you looked at a 20% move in gold in a gold price chart, you wouldn't see it if the chart was a 50-year chart. What attracts me to the gold market is, I think, with the weaponization of the US dollar and the deterioration of the purchasing power of the US dollar, that the move in gold price could resemble the move in the gold price that occurred in the period 2000 to 2010, which was a sevenfold move. But let's throw that out. Let's say that a sevenfold move from a higher base is out of the question, particularly given the investment alternatives in front of us. Could gold give us a threefold move? I absolutely think it could. Do I think it will? I have no earthly idea. Given that I have no way of knowing, I don't care. But if I think that there is a possibility that the gold price could triple, which is to say it went to $7,500, that tells me an interesting thing about what the silver price could do. Because in my prior experiences, once the momentum was led by gold, silver outpaced gold in terms of both the pace and the quantum of the gain. It's important, too, to consider both in the context of gold and silver that while gold has broken out to new highs in a nominal sense, it hasn't really broken out to new highs in an after inflation sense. The suggestion was that the prior high in the silver price was at $50, but that was at 1981 dollars. Uh, that needs to go much higher. In fact, apparently the nominal break even in gold not the nominal, pardon me, the real break even in gold is 2,700 real dollars. So I believe that the gold price goes higher, and I believe that the silver price likely goes much higher. Uh, am I concerned that what we're seeing now might be a false breakout? Sure, absolutely. Let's suppose that I'm 2 years early. If I'm 2 years early and the possible magnitude of the upside in the gold price is a triple, I have no idea what the upside might be with regards to the silver price. And remembering, too, the relationship between the price of silver, which is in fairly ubiquitous supply, and the market capitalization of silver stocks, which is much smaller relative to the value of equities of all classes, one gets a sense of the really quantum upside that could be available in the silver equities. Hence my description of that market as a coiled spring.
When you invest in a silver company, do you look at the same measures of value that you do in other commodity companies that when you invest in them?
I do. Uh, you need to be perhaps a bit more conservative with regards to precious metals companies, um, because it is difficult to establish a fair price for the commodity based on the commodity's utility. They perform unique functions as money. With uranium, we could say that the median cost of production on a global basis in 2020, after tax and after the cost of capital, was 60 US dollars, and that the material was selling for $20. You could tell, too, with uranium, that given the fact that uranium provided 20% of US baseload power, among others, that the price had to go up to the incentive price, at least the incentive price to maintain current production, let alone add new production, or that the commodity was not going to be available. You can't say that with precious metals because, with regards to at least gold, most of the gold that's ever been mined still constitutes supply. If, however, you look at gold or silver on a stock to float basis relative to other mediums of exchange, then you need to look at these materials in the context of their market share of currencies and how relatively small changes in perception, relatively small changes in market share can lead to very rapid increases in price. And when you take this through to the companies that produce them, you have to understand something about the margin expansion that happens as a consequence of this price escalation. When the price escalation gets steep enough that the selling price of the commodity outpaces the escalation in the cost to produce it, you have margin expansion at the same time that you have a market that is willing to be more generous with any other than on a variety of metrics than they are in other cases.
I was trying to quantify how the market was valuing Pan American silver just as an example in the previous cycle, and it's trading roughly at about half the valuation of what it was on various measures, and it's just coincidence that it's exactly half in terms if you look at book or sales
Sure.
or even NAV. It's trading at roughly half of what the peaks have been. But I guess the caveat is that all of these numbers change if we get much higher silver prices.
Yeah, something else you need to remember, Aditya, is that book is useful in many businesses, but in successful efforts businesses like these or technology, book becomes very illusory. There might be company A that has an undepreciated book value of a mine that's $1 billion, and that mine makes no money. One times book would be 1 billion. There could be another company whose undepreciated book value around a mine is $1 billion, and that mine makes $200 million a year. So I think it's fair to say that PNAV is a much, much, much more valuable metric than book.
Yes, and it's also interesting that the PNAV appears the cheapest at the top of the cycle as well.
That is a wonderful, wonderful, wonderful point. What happens in commodities-based businesses is that price earnings and price NAV can be illusory too, in the sense that when a commodity is very highly priced, what happens is that producer cash flows are high, which is to say the E part of the PE is high. These are leveraged. So, ironically, often PE in particular is the highest when the prices are the lowest because there ain't much E. So, part of the game of constructing a portfolio, particularly a precious metals portfolio, but a resource portfolio generally, is to look at both probable and possible pricing scenarios for the commodity and try to understand, first of all, what the NAV would be in different pricing scenarios. I usually try to run a price matrix and also to understand, based on the work that Marty Whitman did about pricing cyclical industries, what the market multiple would be, what the range of market multiples would be in a different commodity pricing scenario.
One of the things I've heard you talk about in the context of gold miners, can you see this chart?
I do. Oh, which are you referring to, the one on the left or the right?
The one on the left, so both of these are costs.
Yep,
And essentially it's the change in costs over from 2000 on the left, it's from 2005 to present day.
yep,
And the other one is, but it's essentially showing you the change in cost relative to the gold price, which is the yellow line.
yep.
And you brought up this point in many discussions about the fact that the gold miners, their free cash flow did not increase significantly over the previous cycle because costs were keeping up with the price of gold based on this chart, and possibly related to the inefficiencies at the management level as well. But when I look at silver companies, with the one exception that we've talked about today, or maybe two or three other exceptions, the we're moving into a business that loses money in most years, and I would argue that it's even more inferior than the gold business from a business perspective.
You and I have discussed before in several interviews the fact that if you invest in the gold sector as a sector, over a decade, you will lose money. That will happen. If you were to invest in the XAU as a sector, likely over a decade, you will lose money. There will be 5 or 6 companies, a subset of 5 or 6 high quality companies in that index that you will not just make money on, you'll make lots of money on. Similarly, particularly in the coiled spring part of the silver market, which is to say the high quality or relatively high quality juniors, out of that whole range of companies that make up these charts, make up these medians, make up these means, make up these averages. If, as an example, there were 100 silver juniors, I suspect there are more. My suspicion is that 7 or 8 or maybe 10 of them would be good speculations. So if you aren't prepared to do the work or pay to have the work done, to differentiate in movie parlance between the good, the bad, and the ugly, you sit this out. Uh, what I notice, however, in my own database is that there's tens of thousands of people who don't want to sit it out. They want to participate. And in that quest, they have to invest enough in their education that they can segregate between the good, the bad, and the ugly. One interesting experience I've had going back 30 years is that, at least at the beginning uh, of that period, I set my expectation on the upside uh, on my own valuations, which is to say, I refused to pay a price that exceeded what I thought was fair value. What I learned is that the market will pay a premium for a high quality deposit. The market believes, rightly or wrongly, that a large, high quality deposit will always yield good surprises. The second thing that happens in a bull market, of course, is that takeovers take place for not cash usually, but shares, which is to say, a currency which itself may be overvalued. I'm reminded of a large share position that I had in a successful explorer called Arequipa. And I remember when Arequipa moved fairly rapidly, by the way, from 30, 40, 50 cents up to $15. I remember thinking that the fair price for Arequipa, as I did the net present value calculation, was about 17 or 17 and a half. And then when the price of Arequipa crossed through 19, I sold an awful, awful, awful lot of stock. A month later, Barrick bid $30 for the whole company. I asked a very good client of mine who had been the CEO of a major mining company what mistake I made. And his first answer was very gracious. He said, when you own a stock from 30 or 40 cents to $19, you haven't made a mistake at all. I said, okay, thank you. What would you say about the $11 I left on the table? He said, oh, well, that's easy to figure out. Barrick bought a deposit for twice your estimate of net present value. First of all, because Barrick didn't care much about your estimate of net present value, but also, too, because they were using a currency that was selling at 3 times net present value by your calculation. So for them, given the odd calculus of bull market math, it was accretive, not dilutive. And I think that that's an important thing that you have to understand.
There you're relying on someone else essentially overpaying for something. So you're on someone else's lack of prudence rather than your own prudence is
Yeah,
the way.
I think that's accurate. I think that you need to, in the context of silver equities in particular, understand that you use an amount of money in speculative activities that corresponds with an amount of money that you're prepared to lose half of. A lot of what I do in my life, Aditya, is to be a lender, which is to say that I'm looking to minimize my downside because my upside is constrained. In the silver equities, I have allocated about 2.5% of my portfolio. If I'm wrong about my silver stock speculations, it won't change my decision as to what to have for breakfast. If I lost 50%, as an example, something I think that's very unlikely given the hate that's already in the sector, it would cost me something in excess of 1% of my net worth. If I'm right, which I think I'm going to be, 2.5% of my portfolio would, if held to maturity, turn into 25% of my portfolio. That juxtaposition of risk to reward is extremely attractive to me. but it requires, in essence, an Eric Sprott mindset. It requires your ability to be durable over time, to endure to volatility, which is often completely unrelated to utility, and to accept real risk in return for realizing truly stupid returns on capital employed. Uh, Participating in the silver space at present is for those clients of yours, and I know whether they admit it or not that you have several, who are looking to get 5x and 7x and 10x returns on capital employed in return for taking disproportionate risk and being uncertain as to both the time and the quantum required to be in the trade. Now, I know too that what the clients really want is a tenfold return for no risk, and they want it to occur by summer, but that's not on offer.
Well, the first thing I will say is that my breakfast decisions are certainly going to be impacted based on my allocations to this space. But if I come back to the question that we were talking about with regards to how to optimize allocations in a speculative sector like silver, given the nature of the business, I spend a lot of my time reading folks like Buffett and Munger who have a very strong view about investing in good companies. And when I look at the gold or the silver space, one of the differences I see there is that the market rewards marginality very differently in a bull market. And when you're positioning speculative capital in the sector at this point in the cycle, uh, do you diverge from the discipline of intelligent, even speculation, where you're buying businesses that are marginal or that have large ounces in the ground, optionality as you have invested in before? Do you change your investment strategy at this point in the cycle as a speculator?
I think that every cycle changes. So I think that there are certain factors, human factors, which are always in play. In the early part of the decade of the 90s, the outlook by then was that commodity prices were never going to go higher. The consequence of that is that truly marginal properties were really cheap. You could buy silver properties that were uneconomic at $5 silver. You could buy them for a nickel an ounce in the ground, which both Silver Standard and Pan American did. And both those companies enjoyed really, truly quantum price increases. The consequence of that is that people are paying up for large marginal properties now. The cover charge, if you will, to get involved in marginality is much higher. So I'm not playing the marginality optionality game anymore. I'm looking in the silver space for deposits that will likely be consolidated by bigger producers as those producers' ability to pay up grows. Or I'm looking in that small subset of producers for the best of the best, the people that have a track record around capital deployment, the people who will be able to enjoy real margin expansion, and the people who enjoy enough respect in what remains of the investment community interested in precious metals, that their franchise will allow them to enjoy premium valuations. In other words, a very, very small subset of the silver sector, and a subset that's fundamentally different than the subset that I would have chosen in the early part of the decade of the 1990s, where there was no value assigned to a deposit in terms of optionality. The prices that are established now for optionality are too high. It's not the place to go. A 300 or 400 million ounce silver deposit that is, a 45 or 50 gram deposit, which is, to say where your in situ value per ton produced is $40 or $45. I'm not interested in buying that. What I'm interested in is buying deposits that are conceptually quite economic in the context of higher silver prices. You have a chart here about enterprise value per ounce. Note that that enterprise value per ounce doesn't take into account the capital cost associated with beneficiating the ounce, the operating cost associated with producing the ounce, or the time value of money, which is to say when the ounce is going to be brought into production, nor does it take into context the social rents, the taxes, duties, and royalties in the jurisdiction that it exists in. You will see, I think, a couple of useful things in this chart, which is to say, rationally, the highest enterprise value per ounce, with one exception, uh, accrues to the companies that are generating reasonable margins or have the prospect of reasonable margins. There is also, I think, probably in this chart, uh, something that goes oddly to perception. The traditional success that Tom Kaplan has enjoyed in natural resource related investments has allowed the ounces at Gatos to be more highly valued than many ounces simply as a bet on Tom Kaplan.
The last question for today is I'd like to end this on a somewhat philosophical note. This is a modified version of a question that you asked Frank Justra in one of your conversations with him recently. The question that you asked him was along the lines of what do some people do differently to be better at investing than others? What advice would you have for people at this point in the silver market in terms of positioning themselves so that they can do better than they would do without your advice?
Uh, First of all, do you have money that you are prepared to risk, truly risk? Are you psychologically prepared to endure volatility? Are you willing to spend 1 hour per month per company in your portfolio? The answer to all those better be yes. Um, I don't think that you have to search any longer for the commodity being out of favor. I think it's through the valley of the shadow of death. So my suspicion is that the recovery is much more proximal than it was. But you still need to differentiate between the good, the bad, and the ugly. And you still need to decide that here in this part of your investment portfolio, that your quest for alpha is more important to you than merely achieving data, which is to say, if you just want to keep pace with the silver market, you can just buy physical silver. Stop. If you are, as many of your clients are, and as I am with part of my portfolio, in search of five baggers or 10 baggers, and you are willing to accept the uncertainty of time, if you are willing to endure equities prices that can go up or down by 10 or 12% a day for no particular reason, I mean, that it doesn't take any courage for me to do that anymore. I've been doing it for 50 years. To me, it's as natural as breathing. But for a lot of people, it's completely unnerving. Um, if you are willing to accept that this activity is really all about uh, accepting good and bad probabilities and possibilities for an outcome which could be extraordinarily good, then you're in the right place. I remember in the process of having my business bought by Eric Sprott, and Eric and I were visiting a lot about speculative philosophy. And he was taking me through or asking me questions about my methodology. And I said to him, much in the sense of what I asked Justra, what do you think I forgot? And he said, well, Rick, you made no mention of upside. You didn't ask the company to describe for you, if the right set of circumstances occurred, what the valuation could be. Your whole discussion was focused on limiting your downside. All that's good, but you don't become a billionaire without focusing on the upside too. And I thought that was a very good question. So, what people need to do in the context of the discussion I had with Frank Justra is do an honest psychological self-evaluation and ask themselves if there is a part of their portfolio where they're willing to subject themselves to uncertainty, both in terms of time and outcome. They're willing to accept volatility. They're willing to accept the risk of being wrong in return for the possibility of five-fold or 10-fold or 15-fold returns.
When you talk about not thinking about the upside, is this related to the upside from the market revaluing what is already known, or is this the upside linked to improbable additions of value to that company in the
Yes,
future?
yes, and yes. I had no idea when I financed Pan American at 50 cents. I think the silver price was at $4. I had no idea that the silver price was going to go to $50. I mean, I had no idea. I thought it might go to 20, might go to 20. I had no idea that Pan American silver would go to $45. I thought it might go to 5 or it might go to 7. I had no idea that this would occur over 6 or 7 years. I thought I had a reasonable chance of, if the investment thesis became popularly accepted, and if Ross Beatty implemented the business plan with the targets that he had in mind at the time I made the investment, I had a sense that the stock could double within 18 months and could go 10 to 1 within 5 years, with the emphasis on could. But I didn't really try to tell myself that I had a silver price target or I had a Pan American target. I had a sense that I might have the opportunity, that the market might give me the opportunity by exceeding what I thought was reasonable value at the time to sell some stock and lower my average cost. I thought, too, that it would take me 5 or 6 or 7 years to realize real success on Pan American. And I thought that what that success would look like in the case of that name would be a 10-bagger. That isn't to say that when I wrote the check at 50 cents, I thought I'm going to have a 10-bagger within 5 years. I put it in the context of a very, very small portfolio of silver companies at the time, thinking that there was a possibility that the silver price would go up. In fact, a probability that the silver price would go up. I didn't know how high. And that the sector would re-rate from hate to acceptance to love. And that's what happened. But that's as specific as my criterion was. And I think it was a realistic set of criterion relative to what was on offer to me or anybody else.